Welcome to the Book Voices channel. If you enjoy our content, don't forget to like and subscribe to stay updated with our latest book discussions. Now let's dive into today's book.
All right, so you ready to dive into this?
Absolutely. Let's do it. Money psychology, always a fascinating topic.
Yeah, and it's something that affects everyone every day, right? But most of us never really stop to think about the psychology behind our financial decisions. We kind of just, go with the flow.
Right, exactly. It's like we're on autopilot most of the time. And that can be, well, a little dangerous when it comes to something as important as money.
For sure. So today we're doing a deep dive into Morgan Housel's book, The Psychology of Money. It's packed with insights about how our minds work when it comes to, well, money, and how those often hidden biases can really trip us up.
Absolutely. Housel's book is a great starting point. He uses a really engaging storytelling approach, which makes it a really accessible read, even if you're not, a finance expert.
Yeah, totally. And that's kind of what we're going for here too, right? We're not going to get bogged down in all the technical jargon. We want to really understand the core ideas and why they matter in our everyday lives.
Exactly. So what really struck me was the very first anecdote Housel uses in the book. It's about this wealthy executive, right, who throws $5,000 at a hotel manager over a lamp that was only worth $500.
Oh, yeah. I remember that story. Like, talk about an overreaction. What was that all about?
Well, Housel uses it to illustrate a really crucial point. Being good with money isn't about how smart you are or how much you know about finance. It's much more about how you behave with your money.
Right. Even brilliant people, even wealthy people can have some seriously flawed financial instincts, right?
Absolutely. And, Housel contrasts the world of finance with, say, the field of healthcare. In medicine, we've made huge progress because of science, right? We have fairly clear-cut guidelines for how to treat diseases, and that's led to longer, healthier lives for most people.
Yeah, that makes sense. So what's the difference with money?
Well, with money, there's so much more psychology involved. Emotions, biases, those hidden mental shortcuts we all take, they play a much bigger role than most of us realize. So while there are definitely some, basic financial principles that everyone should understand, it's really that psychological component that often determines whether people succeed or struggle financially.
So it's less like a science and more like, what, human nature.
Yeah, I think that's a good way to put it. And that's why it can be so confusing, right? Money is this constant presence in our lives, yet it often feels like a complete mystery.
Totally. Okay, so one of the key takeaways from the psychology of money is that everyone approaches money through their own unique lens, shaped by their personal experiences, right?
Absolutely. Like what feels like a no-brainer financial decision to one person might seem totally irrational to someone else. And, it's often not about one being right and the other being wrong. It's just that they're coming from completely different places.
Right, so their backgrounds are totally different. Like, take someone who grew up during a period of, I don't know, really high inflation.
Yeah, exactly. Their whole approach to saving and investing is going to be fundamentally different from someone who's only ever experienced, stable prices. Their whole worldview is shaped by that experience.
Makes sense. And you could also contrast the upbringing of someone whose parent was, say, a super wealthy banker.
Right, right. Versus someone who grew up experiencing real financial hardship. Their fundamental assumptions about risk, reward, even what's financially possible, those are going to be totally different.
Yeah, that's a really interesting point. Like, even if they both end up making the same amount of money later in life, their relationship with money will be so different, right? Because of their past experiences.
Exactly. And, this also applies to bigger historical events, right? Like someone who lived through the Great Depression. Their whole mindset about money will probably be shaped by that experience of scarcity and uncertainty. And they might have a harder time, I don't know, trusting the stock market or taking big financial risks, even if the data suggests that those risks could be worthwhile in the long run.
Yeah, that's powerful. It's like our own personal financial histories, even though they seem kind of small compared to the overall economy, they actually have a huge influence on how we see the entire financial world.
Totally. It's like we're all carrying around this invisible baggage, right? And sometimes we don't even realize how much it's affecting our decisions.
Right. So what Hassel is saying is that we need to be more aware of these biases.
Yeah.
To kind of step back and examine those gut reactions we have to money.
Yeah, I think that's a key takeaway. Don't just blindly follow those gut instincts, those ingrained beliefs about money that you've developed over the years. Question those beliefs, understand where they come from, and see if they're really serving you well.
Okay, so on that note, let's shift gears a bit. Another thing that Housel talks about is how the whole concept of retirement is actually pretty new, historically speaking.
Yeah, it's true. It seems so normal to us now, but the idea of like widespread retirement where most people stop working in their 60s and live off their savings for decades, that really only took hold after World War II.
Wow, that's pretty recent.
Yeah.
So before that, people just worked until they, what, dropped dead?
Pretty much. And even the idea of individuals being primarily responsible for funding their own retirement through things like 401ks and IRAs, those are even newer developments. The 401k wasn't even created until 1978, and the Roth IRA came along even later in 1998. So it's this relatively new era of individual responsibility for our financial futures, and it puts a lot of pressure on people, to make the right choices.
It's a big shift, for sure. And it really brings into focus the whole idea of luck versus skill, right? Like how much of our financial success or failure is really within our control.
Totally. Housel makes this point using the contrasting examples of, say, someone like Bill Gates, who obviously achieved massive financial success, and then this hypothetical person who has all the same talents and drive as Gates, but never quite reaches that level of wealth and fame.
So are you saying it's all just luck? Like Gates just happened to be in the right place at the right time?
Well, it's not all luck, but it's definitely a factor. And, even the Nobel laureate Robert Shiller has talked about this. He said, the market is so complex and influenced by so many things that it's impossible to know for sure whether someone's success is due to skill, luck, or some combination of the two.
Yeah, that makes sense. Like, even the most successful investors have made some bad calls along the way, and they've probably benefited from some lucky breaks, too. It's just that we tend to focus on the successes and ignore the failures, right? Because that makes for a better story.
Right, exactly. Like, take someone like Cornelius Vanderbilt, right? He became incredibly wealthy, but his business practices were, shall we say, questionable at times. Or look at Benjamin Graham, considered the father of value investing. His biggest investment returns came from a single stock, GICO, which actually went against his own rules about diversification. Was that genius? Or was it just a lucky break? That's hard to say for sure.
So is Housel saying we shouldn't even try to learn from those super successful investors?
Yeah.
Like, forget about Warren Buffett and all those investing legends.
Not exactly, but he does caution us against trying to perfectly replicate their results, especially those extreme outliers, because their success is often due to a combination of skill, luck, and timing that's very specific to their particular situation.
Okay, so what should we be focusing on?
He suggests focusing on those broader patterns of success and failure that are more common, more repeatable. Look for those fundamental principles that apply across different time periods and different market conditions.
Got it. So don't just try to copy what Warren Buffett did in the 1970s. Figure out what principles he was following and see if you can apply those principles to your own situation today.
Right. And this leads us to a really important concept that Housel talks about, the idea of enough.
Enough. What do you mean by that?
Well, he tells this great story about Kurt Vonnegut and Joseph Heller at a party hosted by a billionaire hedge fund manager. Vonnegut points out that the host made more money in a single day than Heller had made from his book Catch-22 in its entire history. And Heller replies, yes, but I have something he will never have. Enough.
Wow, that's kind of deep. So it's like, even with all that money, the billionaire still wasn't content.
Right, and that's a trap that a lot of people fall into, right? They think, if I could just make a little more money, then I'll finally be happy. But the reality is that past a certain point, more money doesn't necessarily equal more happiness.
That's a good point. Like, I know people who make a ton of money, but they're miserable because they're always chasing that next promotion, that next raise. They're never satisfied with what they have.
Exactly. And then Housel contrasts that story with the cautionary tale of Rajat Gupta, this super successful businessman who had it all: money, power, prestige. But he still risked everything for more. He got caught up in this insider trading scandal, and he ended up losing his reputation, his freedom, everything.
So it's like that old saying, be careful what you wish for.
Right, and I think the lesson here is that there are some things that are simply not worth risking, no matter how much money is involved. Your reputation, your freedom, your relationships with loved ones, your health. Those are the things that truly matter in the long run.
That's powerful stuff. And I think it goes back to the idea of defining what enough means to you personally. Like, what is that point where you feel financially secure and content without constantly needing more?
Absolutely. Figuring that out is one of the most important financial decisions you'll ever make. Okay, let's move on to a slightly less philosophical but equally important concept, The magic of compounding.
Ah, yes, the eighth wonder of the world, right? At least according to Einstein.
Well, whether Einstein actually said that is debatable, but he certainly understood the power of compound growth.
Hmm.
Housel uses a great analogy to explain it. He compares it to the slow, gradual changes that eventually create massive ice ages. Like, you don't see the ice forming overnight, but over thousands of years, those small, consistent changes add up to something really significant.
Okay, I can see that. So how does that apply to money?
Well, take Warren Buffett, for example.
Yeah.
He's undoubtedly a brilliant investor, but a huge chunk of his wealth comes from the fact that he's been investing consistently for decades, like since he was a kid. Housel actually did the math, and if Buffett had started investing just 10 years later, his net worth today would be something like 99.9% less than it is.
Whoa, that's a lot less. So it's not just about being a good investor. It's about starting early and giving your money time to grow.
Exactly. Even modest returns, compounded over a long period, can produce incredible results. And it's interesting, Housel contrasts Buffett with Jim Simons, this hedge fund manager, who's actually achieved significantly higher average annual returns than Buffett. Like, we're talking about 66% versus 22%. But Simon started investing much later in life, so even with those incredible returns, his overall net worth is still considerably less than Buffett's.
Wow, that really illustrates the power of time, huh? It's like that old saying, the best time to plant a tree was 20 years ago. Second best time is today.
Exactly. The earlier you start investing, the more time your money has to grow exponentially. And one of the reasons we often underestimate the power of compounding is that our brains are wired to think linearly, not exponentially. Housel uses the example of data storage. Like, if you were asked to predict how much data storage capacity would increase from the 1950s to today, you might guess maybe a 1,000-fold increase. But the actual increase is closer to 100 million times. Our linear thinking just can't grasp those kinds of exponential leaps.
Makes sense. Okay, so we've talked about the importance of time and compounding. But, getting rich is one thing, staying rich is another, right?
Totally. Housel emphasizes this by comparing the stories of Jesse Livermore and Abraham Jermansky, two guys who made huge fortunes during the 1929 stock market crash. But here's the thing. Livermore ended up losing everything and tragically took his own life, while Jermansky basically disappeared from history.
So they both achieved financial success but failed to maintain it? What went wrong?
Well, I think the key takeaway here is that survival is the ultimate foundation of long-term financial success. Michael Moritz from Sequoia Capital put it really well when he said, "We've always been afraid of going out of business." That constant fear, that awareness of potential risk, is what keeps you sharp and focused. It's what prevents you from making those big, reckless bets that could wipe you out.
Okay, so paranoia is good.
Well, maybe not full-blown paranoia, but a healthy dose of caution can definitely help you avoid those big financial blow-ups. And it allows you to stay in the game long enough to benefit from those compounding returns we were just talking about.
Makes sense. So what are some ways to prioritize survival in our financial lives?
One crucial element is having a financial cushion, some cash reserves that can help you weather those unexpected storms. Like during a market downturn, having some cash on hand prevents you from being forced to sell your investments at the worst possible time. It's like having an emergency fund, but on a larger scale.
Yeah, okay. That makes sense. I've definitely felt that pressure to sell when the market is tanking, just to stop the bleeding.
Right. But having that cash cushion gives you the flexibility to ride out the storm and wait for things to recover. And that can make a huge difference in your long-term returns.
So cash isn't just about earning interest. It's about having options, about having the freedom to make decisions without panicking.
Exactly. And Housel also stresses the importance of having a financial plan, but with the caveat that no plan survives first contact with the enemy.
The enemy. Who are we fighting here?
Well, in this case, the enemy is reality, right? Like all those unexpected events that life throws at us. Think about the past couple of decades. 9/11, the housing crisis, the global financial crisis, the pandemic.
Yeah, it's been a wild ride.
Exactly. No one could have predicted all of that. So your financial plan needs to be flexible, adaptable. It needs to account for the fact that things will almost certainly go differently than you expect.
So be prepared for the unexpected. Don't get too attached to your plan because it's probably going to change along the way.
Right. And another concept that Housel explores is this idea of long tails and how failure is often a key ingredient in achieving overall success.
Long tails, like the tails on animals. Not sure I follow.
Well, it's a statistical term that basically describes those rare but really impactful events that are way out on the edges of the bell curve, like things that might only happen 1 in 1,000 or even 1,000,000 times.
Okay, so like really unlikely events, but with potentially huge consequences.
Exactly. And these tail events often explain those massive successes that we see in various fields. Like, take venture capital, for example. A VC firm might make 100 investments, fully expecting that most of them will fail.
Oh yeah, I've heard about that. It's like a high risk, high reward kind of game.
Right. And a few of those investments might do okay, but it's usually just one or two that become massive, Google-sized home runs. And those few mega successes make up for all the losses and then some.
Interesting. So they're basically betting on the long tail, hoping to hit those rare but really big wins.
Exactly. And, this idea also applies to the broader stock market. Like, if you look at the Russell 3000, which tracks a huge chunk of the U.S. stock market, a surprising number of companies actually lose most of their value over time. And the overall return of the index is driven by a relatively small percentage of companies that generate those massive outsized returns. It's like another example of the Pareto principle, that 80-20 rule, where a small number of factors drive the majority of the results.
Wow, so even in the stock market, it's really those few big winners that make all the difference.
Yep. And the takeaway for individual investors is this. Your own significant successes will likely come from a relatively small number of decisions that work out exceptionally well. So it's not about trying to be right all the time. It's about positioning yourself to benefit when you are right. Kind of like a poker player, right? They're not going to win every hand, but they're trying to maximize their winnings when they have a good hand.
That's a good analogy.
Yeah.
So are you saying we should just make a bunch of bets and hope that one of them pays off big?
Not exactly. It's not just about making random bets. It's about understanding that failure is a normal part of the process. You can't let the fear of failure paralyze you. Jeff Bezos, after a failed product launch at Amazon, famously said that they were already working on even bigger failures.
Bigger failures. That sounds kind of counterintuitive.
Well, his point was that failure is inevitable, especially when you're trying to innovate and push boundaries. And those failures are often what lead to the big breakthroughs. So you got to embrace them, learn from them, and keep moving forward. And as the legendary investor George Soros once said, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong.
Okay, so failure is not the opposite of success. It's part of the process.
Right. And, speaking of success, Housel makes a really important point about the true value of wealth. It's not just about having a big bank account, right? It's about what that money allows you to do.
Like buying a yacht and a private jet.
Well, sure, you could do that if that's what you're into. But Housel argues that the most valuable thing that money can buy is freedom and control over your own time. Like the ability to do what you want, when you want, with who you want. And that's something that even a lot of wealthy people don't have because they're trapped in this cycle of work and stress.
Yeah, that's true. You see those stories all the time, right? About people who achieve massive financial success, but are deeply unhappy because they have no time for themselves, their families, their passions. They're just constantly grinding.
Exactly. And Housel highlights research by the psychologist Angus Campbell, who studied happiness and well-being. He found that income alone doesn't guarantee happiness. And there's even this psychological concept called reactance, which basically describes that feeling of being controlled or restricted. And when people feel like they have no control over their time, that can lead to a lot of stress and unhappiness.
Interesting. So it's like that feeling you get when someone tells you that you can't do something and you suddenly want to do it even more just to prove that you're in control.
Yeah, exactly. And money can actually help you avoid that feeling of reactance because it gives you more choices, more options. Housel shares this great anecdote about Derek Sivers, this musician who realized he had enough money, like just around $12,000, to quit his job and pursue his music full time. And that relatively small amount of money bought him an immense amount of freedom.
That's inspiring. And it kind of makes you wonder, right? Like, if someone can find that much freedom with $12,000, then how much freedom do we all have with the resources we have now? Maybe we're all richer than we think we are.
I think that's a great point, and it's a real paradox that the U.S., despite being one of the wealthiest nations in history, reports some of the highest levels of worry and stress compared to the global average. We have all this wealth, yet we still feel trapped.
And I think part of the reason for that is that we often admire the wrong things, right? Like we focus on those outward symbols of wealth, the fancy car, the big house, the designer clothes, but we forget about the person behind those possessions.
Totally. And research has shown that even lottery winners often end up back where they started financially because they don't know how to manage that sudden influx of wealth. It's like they just trade one set of problems for another.
Yeah, that's kind of sad. And I think it goes back to that earlier point about knowing when you have enough. Because if you're always chasing that next level of wealth, that next material possession, then you're never going to feel truly content.
Right. And Housel makes a great point that humility and kindness are far more effective at earning respect and admiration than any flashy material possession. It's about being a good person, not just looking like a rich person.
That's a good reminder. All right, so shifting gears a bit, let's talk about savings. It's not exactly the most exciting topic, but it's obviously crucial for building wealth.
Absolutely. And Housel emphasizes that building wealth isn't primarily about getting huge returns on your investments or winning the lottery. It's about your savings rate. Like, how much of your income are you consistently setting aside?
Okay, that makes sense. But honestly, sometimes it feels like no matter how much I save, it's never enough.
Yeah.
Like those financial goals just keep getting further and further away.
Well, it's easy to get discouraged, especially when you see, those crazy stories about people getting rich quickly through crypto or whatever the latest investment fad is. But the reality is that slow and steady wins the race when it comes to building wealth. Housel uses the analogy of the energy crisis in the 1970s.
Hmm.
We didn't solve that problem by simply finding more oil. A big part of the solution was becoming more energy efficient, reducing our overall need for energy in the first place. And you can apply that same principle to your finances, right?
Right. So it's like, don't just focus on increasing your income. Also focus on reducing your expenses and making the most of what you have.
Exactly. And saving isn't always about having a specific goal in mind. Sometimes it's just about creating that financial cushion, that sense of security that allows you to make different choices.
Okay, I can see that. But let's be honest, we're not always perfectly rational when it comes to money, right? Like
Uh,
sometimes we make decisions based on emotions, not logic.
totally. And Housel actually suggests that maybe we should stop trying to be perfectly rational all the time because we're human beings, not robots.
Wait, so you're saying it's okay to be irrational with money?
Well, not completely irrational, but he makes this interesting point about Julius Wagner Jareg, who won a Nobel Prize for intentionally giving patients malaria to treat syphilis.
Wait, what? That sounds dangerous.
It was definitely controversial, but it turned out to be an effective treatment, even though it seemed completely illogical in the time. And Housel uses this example to show that sometimes what seems irrational can actually lead to positive results. And in the world of finance, sometimes the most mathematically optimal strategies might not be the most sustainable for us emotionally.
I think I'm starting to see your point. Like, if a financial plan feels too restrictive, too stressful, then we're less likely to stick with it in the long run, even if it's technically the best plan.
Exactly. Like take Harry Markowitz, one of the founders of modern portfolio theory. When he was deciding how to allocate his own investments, he didn't use some fancy algorithm or model. He just split his money evenly between stocks and bonds because he felt like that would minimize his future regret. And that's a perfectly reasonable approach, even if it wasn't strictly the most rational one.
So sometimes it's better to go with your gut, even if it means deviating from the perfect financial plan.
Well, I wouldn't say always go with your gut, but it's important to find a balance, right, between logic and emotion, and to choose a financial approach that you can realistically stick with, even when things get tough. And sometimes that means doing things that aren't strictly rational, but that give you peace of mind or help you stay motivated.
Like what kind of things?
Well, House gives a few examples. Having a slight home country bias in your investments, indulging in a small amount of individual stock picking for fun, or even paying some attention to economic forecasts, even though those are notoriously unreliable. Like, none of those things are perfectly rational from a purely financial standpoint, but they can help you stay engaged and excited about your financial journey. He even mentions the example of Jack Bogle, the founder of Vanguard, investing in his son's actively managed funds, even though Bogle himself was a huge advocate for index funds.
So even Jack Bogle didn't always follow his own advice.
Well, I think in that case, it was more about supporting his son than about making a purely rational financial decision. And that's okay, right? Sometimes those personal factors should outweigh the purely financial ones.
All right, so now for a topic that's always a bit tricky,
Mm-hmm.
the role of history in predicting the future.
Yeah, it's a constant debate, right? Like, how much can we really learn from the past when it comes to money and investing?
Well, it seems like everyone's always looking to the past for clues about what's going to happen next. Like this time is just like the 1970s, or this market bubble is going to burst just like the dot-com bubble.
Right. And there's definitely some value in studying history, for sure. But Housel cautions against relying too heavily on past data as a perfect predictor of the future. Because in the world of finance, things are constantly changing. New technologies emerge, new regulations are implemented, and the global economy is always evolving.
So you're saying history doesn't always repeat itself, at least not exactly.
Right. And he warns against two main dangers of over-relying on historical data. First, it can create a false sense of security, making us underestimate the possibility of those truly unprecedented black swan events.
Black swans, like those rare birds that no one expects to see.
Exactly. They're those highly improbable, high-impact events that completely blindside everyone. Like, think about major 20th century events like the World Wars or the advent of the internet or the fall of the Soviet Union. No one really saw those coming, and they completely reshaped the world in ways that were impossible to predict based on past data.
Okay, so those are the black swan events. What's the second danger of over-relying on history?
It's that historical data often fails to account for those fundamental structural changes within the financial system itself, like the rise of 401ks and Roth IRAs has totally changed how people save for retirement.
Hmm.
The growth of the venture capital industry has transformed how startups get funded. Even Benjamin Graham's classic book, The Intelligent Investor, while still full of valuable insights, saw its specific stock valuation formulas become less effective over time because the market evolved, competition increased, and things just changed.
So it's that old saying, it's different this time.
Yeah, and while that phrase is often used sarcastically as a way to dismiss any new or unusual development, the reality is that things do change. And those changes can have a massive impact on our financial lives. So we can't just blindly apply lessons from the past to the present, because the rules of the game might have changed. We need to be aware of those shifts and adapt our strategies accordingly.
Right. So history can be a guide, but it's not a crystal ball.
Exactly. And, all of this uncertainty really highlights the need for humility in our financial decision-making.
Humility. So like not being too arrogant about our ability to predict the future.
Yeah, that's a big part of it. Housel uses this great analogy involving card counting and blackjack. Like, even the best card counters know that they're playing probabilities, not certainties. They might have a slight statistical edge, but they also know that they can lose on any given hand. And that's why they never bet everything they have.
So they're leaving room for error, just in case things don't go their way.
Exactly. They understand that they can't control everything and that sometimes bad luck just happens. And that's a really important mindset to have in investing, too. You're never going to be right all the time. No one is.
So don't bet the farm on any single investment, no matter how sure you are about it.
Right, because even if an event has a 95% chance of success, that still means there's a 5% chance of failure. And if that failure wipes you out completely, then it doesn't really matter how often you were right in the past. You need to build in that margin of safety, that financial buffer that allows you to survive those inevitable setbacks.
Okay, I can see that. So practically speaking, how do we build in that margin of safety?
Well, it could mean things like underestimating your future investment returns when you're making long-term financial projections, or simply choosing to save a bit more than you think you'll need. Like, remember Charlie Munger's advice? Aim low.
Aim low. That sounds a bit pessimistic.
Well, it's not about being pessimistic. It's about being realistic and acknowledging that things don't always go according to plan. And, Housel even suggests this barbell approach to managing risk, where you're really aggressive in one area of your financial life and very conservative in another.
Interesting. Can you give an example?
Yeah, like maybe you're super aggressive with your stock investments, but you also have a very low mortgage payment or no debt at all. So you're balancing that high risk with a high level of stability in other areas of your life. It's like having multiple safety nets in place just in case one of them fails.
Okay, I like that idea. And ultimately, it's about having the freedom to make choices
Right,
without feeling financially trapped or stressed out.
exactly. And that brings us to another fascinating concept that Housel explores: the end of history illusion.
The end of history. Like when Francis Fukuyama declared that history was over after the fall of communism.
Well, not quite. In this context, the end of history illusion refers to this psychological phenomenon where we tend to underestimate how much our values, goals, and priorities will change over time. Like, we kind of assume that we've already become the definitive version of ourselves and that we'll basically stay this way forever.
So we think we've reached the end of our personal evolution.
Yeah, kind of. And the research actually shows that people of all ages fall prey to this illusion. Like, if you ask a 20-year-old what they'll be like in 10 years, they usually describe a person who's very similar to who they are now. And then you ask a 30-year-old to look back on their 20-year-old self, and they're often amazed by how much they've changed.
That's funny. I can definitely relate to that. Like, I look back at some of the decisions I made in my 20s, and I'm like, what was I thinking?
Right. And the problem is that this end of history illusion can really mess with our long-term financial planning. Because if we assume that our current priorities.
This marks the end of part 1 of our book discussion. If you enjoyed the content, let us know in the comments. Your feedback will help us decide when to share part 2.